Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hemoen. As always, we're here to give you the latest updates on the real estate market, trends, and regulatory changes affecting Ontario. Whether you're a seasoned investor, a first-time homebuyer, or just curious about the market, this podcast is your go-to source for expert insights. In today's episode, we have some interesting developments to discuss. Let's start with the Greater Toronto Area, where home sales have been ticking downward despite recent drops in interest rates. According to the Toronto Regional Real Estate Board, home sales in July were up from last year but down from the previous month. The board reported that 5,891 homes were sold in July in the Greater Toronto Area. This is a significant drop of about 13% from June, when 6,202 properties changed hands. July also marked the second lowest month for sales this year, coming in after January, when only 4,179 properties were bought. From January, sales had been on an upward trajectory, reaching a peak of 7,083 in April before falling steadily each month since. The recent decreases suggest that buyers aren't moving off the sidelines as quickly as some had expected when interest and mortgage rates began to inch lower in recent months. Kaylee Heaps, the president and chief executive officer of the Heaps Estrin real estate team in Toronto, commented on this trend. She mentioned that the interest rate reductions so far haven't been enough to push buyers and sellers back into the market with any sense of urgency. She added that while these reductions are a positive sign, the market is still behaving cautiously due to continued uncertainty and weakness in the broader economy. She anticipates a slow and steady climb back to a balanced market, especially given how unpredictable this summer has been. National Bank of Canada economist Darren King echoed these sentiments. He pointed out that Toronto's job market has deteriorated rapidly in recent months, more so than in the rest of the country, which should weigh on the dynamism of the real estate market. He urged people to be prudent about any rebound in market activity they might be seeing. However, there are some encouraging signs in the numbers, according to TRREB President Jennifer Pierce. She noted a 3.3% rise in year-over-year home sales. Pierce expects further rate drops to soon cajole people back into the market. She mentioned that the cost of borrowing is anticipated to decline further in the coming months, which should accelerate sales as buyers benefit from lower monthly mortgage payments. The buyers who have waded into the market early have found plenty of choices, as sellers have increasingly moved to list their homes for sale in recent months. New listings totaled 16,296 in July, up 18.5% from last year. Listings growth outpaced sales on a year-over-year basis. Jason Mercer, TRREB's chief market analyst, weighed in on this as well. He pointed out that as more buyers take advantage of more affordable mortgage payments in the months ahead, they will benefit from the substantial buildup in inventory. This will initially keep home prices relatively flat. However, as inventory is absorbed, market conditions will tighten in the absence of a large-scale increase in home completions, ultimately leading to a resumption of price growth. The average selling price in July was $106,617, down 0.9% from July 2023, when it was $1,116,950. It was also down from June, when the average home sold for $1,161,994. The average detached home price in July was $1,425,927 for the Greater Toronto Area, while the average condo price was $718,698. The composite benchmark price, which aims to represent typical homes, was down 5% in July from a year earlier. So, what does this all mean for you? Well, if you're a buyer, this could be a good time to enter the market, as there are plenty of listings to choose from and prices are relatively flat. If you're a seller, it might take a bit longer to sell your home, but the market conditions are expected to tighten in the coming months, potentially leading to price growth. As always, staying informed and keeping an eye on market trends will help you make the best decision. Let's move on to the London and St. Thomas area, where both home sales and prices saw a slight dip in July. However, the number of new listings remained stable compared to the previous month. According to new figures from the London and St. Thomas Association of Realtors, the average price of a home in this region stood at $654,593 in July. Kathy Amos, the chair of the London and St. I. Thomas Association of Realtors, commented on these numbers, stating that the local real estate market is balanced. People are confident in where the market is heading and are comfortable putting their properties up for sale. She noted that the market does not really favor either the buyer or the seller right now. This is quite different from what we have been used to in the last 2 years, making it a more favorable situation for both parties involved. For those looking at the numbers, at least 604 homes were sold in July, which is down from 678 in June and 640 in July of last year. The region saw 1,131 new listings hit the market, which is roughly 1% lower than July 2023, but about 7% higher than July 2022. Kathy Amos also pointed out that the summer is generally slower for real estate. It will be interesting to see how the Bank of Canada's recent interest rate cuts will affect things in September, when sales typically pick up. The Bank of Canada cut its key interest rate for a second consecutive month in July, bringing it down 25 basis points to 4.5%. The central bank did the same in June. Bank of Canada Governor Tiff Macklem mentioned that further cuts are reasonable to expect if inflation continues to ease. Kathy Amos said she's hopeful for these additional cuts, as they will help people who are sitting on the fence make a decision. Those who have been sitting on the sidelines might find that they can now afford a little bit more in a home. Further declines in interest rates would also benefit those with fixed-rate mortgages coming up for renewal. First-time homebuyers can now qualify for a 30-year amortized mortgage to purchase new homes as of August. This could make things a little more affordable for new homeowners and increase demand for new builds. As of July, the average sale price of a home in London and St. Thomas stood at $654,593, which is down from more than $671,000 in June and nearly $669,000 a year ago. Overall, average prices for single-family homes, condos, and townhomes all fell compared to the previous year, while average apartment prices increased by 16.8% to $445,460. London, Middlesex, Strathroy-Caradoc, and St. Thomas saw average prices fall slightly or stay relatively flat compared to July 2023. The exception was Adelaide Metcalfe, which saw a significant rise of 35%, bringing the average price to $960,000. Kathy Amos mentioned that the recent move to allow first-time home buyers to qualify for 30-year amortized mortgages is expected to make things a bit more affordable for new homeowners. This should also increase demand for new builds. The region had nearly 5 months of housing inventory on the market in July, up from 3.3% in 2023 and just 0.9% in 2021. Listings were on the market for a median of 22 days last month. Let's talk about the recent drop in fixed mortgage rates, something that could have a significant impact on anyone looking to buy a home or renew their mortgage. When markets drop like they did on Monday, you may not immediately think about the impact on mortgage rates. However, this recent dip in the market is actually leading to some noteworthy changes in fixed mortgage rates. We've been relying on the Bank of Canada to nudge rates lower, especially for variable mortgages. But today, fixed mortgages got a news headline-worthy update thanks to bonds, which are reacting to yesterday's global stock sell-off. Bond yields have a positive correlation with fixed mortgage rates. This means that when bond yields go up, fixed-rate mortgages also go up, and vice versa. Since Canadian 5-year government bond yields have dropped to 2.9% as of Tuesday, mortgage rates are expected to come down too. For those who might not be familiar, bonds are a form of debt security. Governments and corporations issue bonds to borrow money from investors. The amount borrowed is referred to as the bond's face value or par value. Interest is paid on the face value to reward investors for lending their money. The rate may be fixed, remaining constant over the duration of the bond, or variable, changing over time in response to changes in a benchmark interest rate such as the prime rate. Bonds are commonly referred to as fixed income securities, regardless of whether their interest rates are fixed or variable. According to ratehub.ca, fixed mortgage rates are on their way down. Penelope Graham, a mortgage expert at ratehub.ca, mentioned that bond markets have dropped in response to yesterday's massive stock sell-off and are now at 2.97%, a low not seen since June 2023. This marks a 20 basis point drop in just the span of a week. Graham noted that this will certainly prompt additional discounts for fixed mortgage rates, on top of the lower rates we've already seen hitting the market in recent weeks. Bond yields have been trickling down for a while now, especially with the recent Bank of Canada interest rate cuts on June 5th and July 24th. Yields hovered around 3.3%, hinting at a drop in fixed mortgage rates. Yesterday's investor sell-off indicated a lack of confidence from investors, further pushing bond yields down. So, where do mortgage rates sit now? Currently, the lowest insured 5-year fixed mortgage rate is 4.29%, which is the lowest a 5-year term has been since last May. With further decreases expected, it's a good idea for mortgage shoppers and those looking to renew their mortgages to look into their rate hold options. Rate holds can guarantee today's low rates for up to 120 days, giving people some peace of mind as they navigate these uncertain times. As for the market, some investors are relieved to see stock prices drop, especially those of technology companies, including the so-called Magnificent Seven, which have had mixed earnings this quarter. This drop in stock prices has not only made fixed mortgages more affordable, but has also made some sought-after stocks more accessible. So, what does this mean for you? If you're in the market for a new home or looking to renew your mortgage, now might be a good time to lock in a fixed rate. With bond yields continuing to drop and further decreases expected, securing a low rate could save you a significant amount of money over the life of your mortgage. As always, staying informed and keeping an eye on market trends will help you make the best decision. Let's talk about BTB Real Estate Investment Trust, which has recently adjusted its mortgage strategy amid a decline in net income for the second quarter of 2024. BTB, a commercial lender that invests in industrial, suburban office, and necessity-based retail properties across Canada, reported a net income decline to $7.3 million for the quarter ended June 30. This is down $3.5 million from the same period last year. The decrease in net income was primarily due to a rise in net financial expenses by $2.6 million and an increase in administrative costs by $0.8 million. BTB also experienced a slight decline in net operating income, which fell 0.5% quarter over quarter to $18.9 million. Despite the decline in net income, BTB saw positive developments in other areas. Rental revenue increased by 1.6% to $32.2 million for the quarter, driven by a record-high occupancy rate of 94.6%. The company also renewed 216,605 square feet of leases and signed 40,080 square feet of new leases during this period. Michel Leonard, the president and chief executive officer of BTB, commented on these results, stating that they are a testament to the organic growth of their portfolio and property management. He noted that their funds from operations, FFO, adjusted and adjusted funds from operations, AFFO, adjusted also saw positive growth compared to the previous quarter, reflecting the strong performance of their assets. Leonard also acknowledged the challenges posed by rising interest rates. To mitigate their impact, BTB has been extending the maturity dates of its mortgage refinancing. He explained that by spreading out their mortgage refinancing maturities, they aim to counteract the fluctuations in interest rates on mortgages in recent months. With the latest announcements from the Bank of Canada, the outlook appears to bode well for future refinancings of their portfolio. This strategy demonstrates BTB's proactive and prudent approach to debt management in the current environment. Leonard further highlighted the REIT's ongoing strategic priorities, which include targeted property dispositions and acquisitions, prudent capital management, and property improvements. As of June 30th, BTB's portfolio included 75 properties, with a total leasable area of approximately 6.1 million square feet and a total asset value of $1.236 billion. The market capitalization stood at $274 million, with units trading at $3.13 per share. So, what does this mean for you? If you're an investor in commercial real estate, BTB's strategy to extend mortgage maturities could be a sign of stability and prudent management in a fluctuating interest rate environment. For potential tenants, the high occupancy rate and record lease renewals indicate a well-managed portfolio that could offer attractive leasing opportunities. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. It's clear that the real estate market continues to evolve, with both challenges and opportunities on the horizon. As always, staying informed and keeping an eye on market trends will help you make the best decisions. Thanks for tuning in, and we'll catch you in the next episode.